If you are trying to navigate the head of household requirements, you know the IRS rules can feel like a maze. Today, we'll explain that qualifying isn't just about who you live with, it's about proving you provide the financial foundation for that home. We're going to explore the critical distinction between personal upkeep and household upkeep, and why knowing the difference is the key to protecting your refund. So, grab your notebook and let's get into the math behind the home you've built. Now, usually we think of head of household as a title for the person in charge, right? The parent, the guardian, the decision maker. But when it comes to taxes, the IRS doesn't care about who makes the rules. They care about who pays the bills. Specifically, they care about the head of household requirements regarding the support test. So let's define the standard. What exactly counts as keeping up a home? Here is the golden rule. To qualify, you must pay more than half the cost of maintaining your household for the year. That's the math. But here is where people get confused, and this is a critical distinction. The IRS separates the building from the people. When you are calculating the cost of keeping up a home, the IRS is looking for expenses that benefit the entire household structure, the container that holds your family, rather than the individual personal needs of the people inside it. Think of it like maintaining a car versus buying accessories for the driver. Buying gas and changing the oil keeps the car running for everyone. Buying a cool pair of sunglasses only helps the driver. The IRS wants to know if you are paying for the gas and oil of your home. So, what goes on the yes list? What are these head of household qualifying expenses? First, think about the physical structure. This includes property taxes, home insurance, and repairs. If the roof leaks or the furnace breaks, those repair costs count because they keep the home livable. Then, think about what makes the home function. Utilities are a big one: heat, lights, water. And here is my favorite one because it impacts our weekly habits. Food eaten in the home. This is a huge category. We aren't talking about ordering pizza or grabbing fast food. That's considered a personal convenience. We are talking about groceries, the bread, the milk, the ingredients for Tuesday night tacos. I want you to take a second and reflect on that. How often do we blur the lines in our budgeting between household food and personal dining out? Knowing that groceries count toward your tax qualification might just be the extra motivation you need to cook at home a little more often. Now we have to talk about the biggest expense for most of us: shelter. But there is a nuance here depending on if you rent or own, and you need to know these IRS head of household rules to stay safe. If you are a renter, this is pretty straightforward. Your full rent payment counts toward the cost of keeping up the home. However, if you own your home, the math changes. You cannot count the principal part of your mortgage payment, and you cannot count the fair rental value of the home, which is basically what you could charge if you rented it out. You can only count the mortgage interest, your property taxes, and your insurance. Why does the IRS do this? Because they want to measure the current out-of-pocket cost of maintaining the shelter, not your investment in the property's equity. So let's wrap this up with a clear takeaway. Qualifying for head of household isn't just about being a parent. It's an exercise in financial proof. It's about proving you are the one keeping the roof up and the lights on. Here is your homework, and it's a vital step for your safe and sound financial strategy. I want you to review your bank statements from the last year. Grab a highlighter, digital or analog, and highlight the big three qualifying expenses: shelter rent or mortgage interest, utilities, and groceries. Seeing these numbers in black and white is the first step to knowing if you pass that 50% support test. But wait, before you start adding up every receipt you find, we need to talk about what doesn't count. You might be surprised to learn that some of your biggest monthly bills, like clothing and medical expenses, are totally invisible to this specific IRS calculation. We are moving into the exclusions, or as I like to call it, the stuff you pay for that the IRS basically ignores. Here is the reality. When you are stressing about hitting that 50% mark to prove you pay for more than half the cost of keeping up a home, the temptation is to throw every receipt into the pile. You think, well, I bought my kid's winter coat, I paid for his braces, and I paid for his math tutor. Surely that counts as supporting the household. But here is the personal expense trap. The IRS looks at the house as a physical container. They care about the container, the walls, the heat, the roof. They generally don't count the personal items attached to the specific people inside it. So, clothing does not count. Education expenses, nope. Medical treatment and health insurance, essential for life, absolutely, but they are excluded from the keeping up a home math. Why? Because those expenses follow the person, not the home. If you moved out tomorrow, you'd still need clothes and health care. The house wouldn't. Now let's look at the second big category that trips people up: transportation and leisure. I know for a fact that for most of you listening, especially the single parents out there, the car is the lifeline of the household. You can't run the house without the car. But under IRS head of household rules, your car payments, your gas, and your auto insurance are strictly excluded. They do not count toward household maintenance. The same goes for vacations. You might take the family on a budget trip to the beach, and that is a beautiful memory. But the IRS views that as a luxury or a personal activity, not a requirement for maintaining the physical dwelling. And here's the third exclusion, and this one usually stings the DIY crowd: the value of labor. Let's say the kitchen sink leaks. If you call a plumber and pay them $200, that $200 counts as a repair expense. But if you are handy and you spend your Saturday afternoon fixing it yourself, the value of that labor is $0 in the eyes of the IRS. You cannot bill yourself for your own time, and you can't count the value of chores done by your kids or other household members. Only the cash you spent on the parts counts. So, why does this matter? Why am I telling you to ignore these huge costs? It changes how you approach the math. When you sit down with the worksheets from IRS Publication 501, understanding these exclusions prevents you from inflating your numbers. Think about it. If you accidentally include your car payment and your kids' tuition in the total cost column, you are making the total pot of money much bigger. That actually makes it harder for your personal income to cover 51% of it, especially if you are receiving child support or other outside help. By stripping out these household maintenance expenses that don't qualify, you are looking at a smaller, more accurate total, which focuses purely on the shared shelter. I want you to take a second and reflect on your own budget. How much mental energy do you spend tracking things like clothes and gas for tax purposes? Understanding the difference between personal support and household maintenance frees you up. You stop hoarding the wrong receipts. So here is the takeaway. The IRS draws a hard line between the house and the people. The house gets the deduction, the personal lifestyle stuff does not. Here is my challenge for you this week. Create a do not include list for your tax preparation. Literally write it on the front of your tax folder. No clothes, no cars, no tuitions. This ensures you don't accidentally inflate your total costs with ineligible personal expenses and trigger a red flag. Now, speaking of things that complicate the math, what happens when you are paying the bills, but the money is coming from somewhere else, like child support or public assistance? Who actually gets the credit for paying in the eyes of the IRS? That is exactly what we are breaking down next. And let's be real for a second. Raising a family is often a team sport. Even if you're doing the heavy lifting, maybe you get some help from the state, or maybe there's a check coming in every month from an ex-spouse. If that sounds like your life, listen up, because this is where the math gets tricky. We are diving into the math of outside assistance, child support, and TANF. The big question here is, does receiving help disqualify you from being the head of household? Here is the golden rule, and I want you to visualize this. The source matters. When the IRS looks at the head of household requirements, they aren't just checking to see if the electric bill was paid. They care whose money paid it. To claim this status, you have to pay more than half the cost of keeping up a home. But when outside money enters your bank account, the math changes. Let's break down the two biggest sources of outside help. First up, public assistance rules, specifically regarding TANF temporary assistance for needy families. Here's the deal. If you use TANF benefits to pay for household expenses, like buying food or paying a portion of the rent, the IRS counts that money toward the total cost of maintaining the home. However, they do not count it as money you paid. Think of it like a potluck dinner. You brought the main course your income, but the state brought the side dishes TANF. The IRS looks at the whole table and says, okay, there's a lot of food here. But when they ask, did Alex provide more than half the food? Those side dishes count against you. They inflate the total cost of the home, raising the bar you have to jump over with your own earned income. Now let's talk about the one that catches almost everyone off guard, the child support distinction. This is a huge confusing point regarding child support and head of household status. Logic tells us the money comes into my account, I swipe my debit card at the grocery store, therefore I paid for the groceries. But under IRS head of household rules, that is wrong. The IRS views child support and even Social Security benefits paid to a child as money provided by the child or the other parent. Even if you are the one physically paying the bills, if the source of those funds was child support, you cannot claim that you provided that specific support. So picture this scenario. Your rent is $1,000. You earn $1,500 from your job, and you receive $1,000 in child support. If you use that child support money to pay the rent, the IRS views that as the other parent or the child keeping up the home, not you. This leads us to our final point, calculating the ratio. You have to look at this like a seesaw. On one side, you have the amount you paid using your earned wages. On the other side, you have the amount others paid. That includes the ex-spouse's child support, the state's TANF, or even money grandma gave you to fix the boiler. To win the head of household title, your side of the seesaw, your earned income spent on head of household qualifying expenses, like rent, utilities, and food, must be heavier than everyone else's combined. I want you to pause and ask yourself a question that might change how you pay your bills next month. How does the source of the money used to pay a bill change the IRS's view of your financial leadership in the home? If you receive significant child support, are you using that specific money to pay the rent? If you are, you might be accidentally disqualifying yourself. Strategically, you generally want to use your earned income for the household upkeep, rent, food, utilities, and use the child support for the things that don't count toward the test, like the kids' new clothes, school supplies, or their personal electronics. So, here is the takeaway. Just because you physically pay the bill doesn't mean you get the credit on your taxes. You have to track the source. Here is your mission for this week. Categorize your income sources for the tax year to determine exactly how much of the household maintenance was funded by your earned income versus outside assistance. Sit down with your bank statements. Highlight money from work in green. Highlight child support or TANF in red. Then look at which bills were paid with which money. If the red money paid for the roof over your head, you might need to adjust your strategy for next year. Now that we understand the math, we need to talk about how to prove it so you can sleep at night without worrying about an audit. Up next, we're going to break down the S3 strategy: simple, sound, and safe documentation. If you're feeling a little overwhelmed by the calculator, I want to give you a framework to make this stick. We call it the S3 strategy. It stands for simple, sound, and safe. This is how you take all those IRS head of household rules and turn them into a system that actually works for your life. Let's start with the first S, simple. When you're staring at a shoebox full of receipts, your brain naturally wants to overcomplicate things. You start worrying about car payments, braces for the kids, or that vacation you took 3 years ago. But remember, the cost of keeping up a home isn't about the people. It's about the structure. I want you to simplify your focus to just 2 things, roof and food. That's it. It's the mortgage interest or rent keeping the rain off your heads and the groceries in the fridge. When you filter out the noise of personal expenses, the list becomes much shorter and much more manageable. Keep it simple. If it keeps the house running and the family fed, it probably counts. Next up is sound, and this is really about your mindset. I want you to think of this calculation not as doing taxes, but as an archaeological discovery. When you sit down to fill out Worksheet 1 from IRS Publication 501, and yes, you really do need to use that worksheet, you are doing more than math. You are digging through your bank statements to uncover the truth of your financial leadership. Every time you log a utility bill or a property tax payment, you are documenting the foundation you provide for your family. It shifts the narrative from, I hope the IRS gives me a refund, to I have sound proof that I am the head of household. It's an exercise in validation. You are proving mathematically that you are the one holding it all together. And finally, let's talk about being safe. We know the term audit keeps people up at night, but anxiety usually comes from the unknown. To make your claim safe, you need to audit-proof yourself before you file. Imagine the IRS sends a letter 2 years from now asking for proof of your head of household requirements. If you have to scramble through old emails and dusty drawers, you're going to panic. But if you have a dedicated system, a fortress, really, containing your lease, your utility summaries, and your grocery receipts, you have nothing to fear. You're safe because you have the receipts to back up your story. I want you to take a second and reflect on that. How much anxiety could you release if you stopped viewing tax season as a test you might fail and started viewing it as a chance to document your financial leadership? And be honest with yourself. What gaps do you have right now? If you had to prove the cost of keeping up a home tomorrow, is your evidence ready or is it scattered to the wind? So here is your mission for this week. I want you to take action on the safe part of our strategy immediately. Start a folder, physical or digital, whatever works for you, and label it in big bold letters, HOH Evidence. Print out your Worksheet 1 calculation and slide it right into the front with your supporting receipts behind it. Do this and you'll sleep a whole lot better knowing your refund is secure. And that brings us to the end of our deep dive into the HOH math. We've unpacked the specific head of household requirements so you can approach tax season with confidence, not confusion. Today, we clarified exactly what makes up the cost of keeping up a home, focusing on the roof and the fridge, and why the IRS distinguishes that from personal support. We also navigated the crucial exclusions, making sure you know which head of household qualifying expenses belong on your worksheet and which ones, like clothing or vacations, strictly do not. And perhaps most importantly, we broke down the IRS head of household rules regarding outside assistance so you know exactly how child support or TANF impacts your eligibility. I hope the S3 strategy really resonates with you this week. Remember, taking the time to organize your receipts and fill out the worksheets from IRS Publication 501 isn't just about checking a box. It's about documenting your financial leadership. It's proof of the foundation you provide for your family, and that is something to be proud of. Thank you so much for trusting me with your time today. If you found this breakdown helpful, please check the show notes where we've linked the specific worksheets and a checklist for your HOH evidence folder. And if you have a moment, leave us a review. It helps other families find this information. Until next time, keep your records organized, trust your math, and keep your finances safe, simple, and sound. This is Alex, signing off.